So what I have on here is the 4 phases of real estate. The 4 phases are: phase 1 is recovery, phase 2 is expansion, phase 3 is hyper supply, and then phase 4 is recession. And so, hey, going back to 2009, 2010, we started the recovery, right? That's when a lot of the single family residential, we were in that recovery after that horrible recession, after that crash, or maybe we're going from recession to recovery on there right now. So my question here is, hey Colorado, Chris Lopez here with your monthly podcast to go over the monthly market updates and trends. For this month, we'll be talking about data we have from April. We're recording this in the middle of May, but we're talking about the April stats since those are out. So I've got almost a full usual crew here with me. Brandon from Key Renter, Troy from Nova Home Loans, and Jeff with Envision Advisors. Good afternoon, guys.
Good afternoon. Happy to be here.
Unfortunately, Jenny from Springs couldn't make it today, but we got the 4 of us. So we're going to talk about the Denver market trends. We got some interesting data to talk about multifamily vacancy and the forecast on there. Office trends data, which is just more higher vacancies, the punchline there. And we'll also talk through a couple deals. You guys ready to jump into it?
Let's do it. Ready to roll.
All right. Well, let's start with the trends like we always do, right? So this is the Denver Metro Association of Realtors. So looking at residential, looking at detached and attached homes, active listings. So here at the top, we were seeing almost 12,000 at the end of April, which is almost double of what we had in this time last year. We were at 6,900 last year. Now we're at 12,000, so it's actually 71% is a technical amount.
Is that just anecdotally check out for all you guys too? Like, doesn't it seem like when you drive around, there's a for sale sign everywhere?
Seems more well. I guess it's relative, right?
Maybe it's my neighborhood. I don't know.
Well, maybe I think because it's been such a seller's market for so long that stuff moves so quickly that you're not used to seeing them as much. Because
they stay up.
You probably have to remember,
point,
go back to 2012 or so before we had at least more trending towards the buyer's market. So it's been a long, long time, and I think that's why. And you probably noticed it because of the headline. Like, I'm sure it's in your mind of totally. Oh yeah, the head. Like,
I'm
it's
cued
more
in to notice it.
Yeah.
Everybody leaving your neighborhood, Brandon, because of you?
It feels like it.
Are you keeping your yard nice?
Yeah.
Yeah, I mean, so here's the chart right here of the last 10 years of inventory. And you can see that green line is the active we talked about here, just, right kissing 12,000 up there. This is by far the highest it's been in the last 10 years. Jeff, I think you're right. I think it's like 2011, 2012 since we're around this inventory. So, I mean, this is the highest it's been. And it'll probably increase a little bit more since we're still in the traditional listing season, even though it's been underwhelming this year from a deals perspective. It'll creep up some more is what my estimate is. I mean, based on the trends, I don't see why it wouldn't.
Yeah, they're not selling fast.
Yeah.
Right. Days on market going up.
Yeah, I mean, days on market up from 30 last year to 37. But the biggest difference here, again, is what we talked about, right? I'm scrolling down here. So we got detached and we got attached. Both listings are up for detached and attached, but look at the detached prices. Average year over year is down negative 1.4% for detached and up 0.7 for median. But condos down 5% average and down about 6% on the median price point. So we're just starting to see that continued divergence of attached properties and also single, detached properties as well.
You'll notice too the closed, just the number closed, it's almost flat with the detached. It's down or it's up 0.5%.
The close for the detached?
Yeah.
Yeah, so it is, we closed about 2986 April 24. We closed 3,000 in April. So yeah, we're up 0.5%.
Yeah, but the condos, the volume's way down.
Yeah, we're down about 13%. So about 1,000 last April and sold in the high 800s for April here, or April 2025. So, I mean, is this surprising anyone here seeing this data?
The one I'm surprised on actually is the detached single family houses are still flat. So you see the headlines, the market's gone down. If you look closed median price, for detached is 0.68%. So that tells you even in the current market conditions, single families are still the most desirable asset to buy and sell because you guys have more buyers interested. And flat, pretty much, I just call it flat. It's close enough to zero, but it hasn't been as scary as maybe headlines have indicated. Like, because you could easily tell a story like, oh yeah, attached has gone down 6% year over year. That's a little more something to keep an eye on. Is like we haven't seen negative in a long time, and it does tell why is attached versus going down versus detached. And I think the pretty obvious reason is like insurance and HOAs, and then less buyers for condos and townhomes because they can't qualify or the
financing.
They can't get it.
Yeah.
Well, how is the rate environment this like April of 2024 versus April of 2025?
Pretty flat. I was looking at that. Same. Yeah, it's still kind of mid-high sixes kind of thing on a 30-year fixed loan. So yeah, we're still in that kind of world.
So that doesn't have a big impact on these.
No, I mean we've been worse for sure. Yeah. So yeah, I'm kind of glad to see that. We're still kind of hopeful it'll get better, but hey, we've got the hand we're dealt, so let's play it.
Yep.
So I want to pull up this chart here. I got two charts I want to get your guys' opinion on here. So this is from Q1 2025 Castle data, and they're showing seller's market, balanced market, or buyer's market. And a lot of times this is distinguished by inventory. So you can see on the bottom red here, 2021 was a strong seller's market or a dysfunctional seller's market. I mean, it was crazy right back then. Yeah. But before then, from 2012, it was a seller's market. And then since 2022 to now, it's a seller's market. So here, the two interesting things to me is that we are still very much from an inventory level in a seller's market, right? We're I think around 2.5, 3 months inventory.
Is this based on the absorption kind of calculation?
Yep.
Okay.
And you see a balanced market is usually between 4 to 6 months worth of inventory, which should be around 15,000, 16,000, residential listings here in Denver. So 4,000 or 5,000 more than we're currently at. Would get us starting in your castle's best guess a balanced market.
So is that is everybody who's saying this is a buyer's market just being nearsighted, or is there other data that would suggest that? I don't know.
I think people can make the case either way, right? From some data it looks like, hey, seller's market based on inventory. It sure does not feel like a seller's market though, right? I mean listing a condo, listing a multifamily, listing a single family home not in a great location does not feel like a seller's market.
Sure. Or if you looked at something like level of concessions or price drops or something like that, would that?
I mean, there was a number to close price to list ratio. I think it was 99.
It was still 99 point.
It was still pretty. So you're not. So the concessions
are getting slashed.
Right. So I don't think you do see some of that though. Obviously, the thing I tell buyers, especially the long days on market, is your big tell. The longer it sits on the market, the more mortgage payments the seller pays, the more likelihood that you'll be able to get a seller credit or rate concessions and price drops. And sometimes you have to put out a disrespectful offer, test the seller motivation, and then that's how you end up with our last podcast, a 40K seller credit. Yeah. It's not so much do they advertise? Oh yeah, 40K seller credit. Sellers don't usually advertise that, but you do see more comments in MLS. I've seen more oh yeah, rate, use our preferred lender, you get rate buy down, but it's you can use any lender for rate buy down. It's it's stuff like that, and the keywords of the listing description. I'm starting to see a little bit more of that, but still, not a full on buyer's market where you could just get 5-10%. Offers accepted price from the list price, at least not yet.
Sure. Yeah. So here's a chart, and this is showing days on market by the month it was sold in, and then that black line is showing the rolling 12-month average. So based on the average right now, I mean we're right around the lows we were in 2017, 2018, 2019. That purple line is the days on market sold for that month, and you can see here the last 2 years or so, that days on market has been higher than the average, which means, hey, that will drag up the average on there. But like overall in the market, like days on market is nowhere near in like the crazy range, or even where it was back in like the 2008 great financial crisis range.
That's a good graph.
Those were, in the 80, 90, 100 days range back then.
Yeah.
So the message here is it could get a whole lot worse for sellers.
Well, thanks for
It
the
can always
pick-me-up.
get worse. But also the nuance on here where this like, hey, averages are great, but then, I mean, we know what's going on here. You go out there and you want to list a $1 million home in Bonnie Bray or neighborhood, you'll have 2 or 3 offers in the first week if it's priced right.
Yes.
And they can have a condo or a house 90 days before you even get one offer.
Yep.
And so it's just more like you have to dig down the averages, because I think depending on the asset class, telling a lot more different stories on here.
Yeah, and I think there's a lot of to that point. I think there's a lot of micro markets around the town, right?
Absolutely.
I think that's exactly what you're talking.
Word.
You know, there's desirable areas like Bonnie Bray, Highlands Ranch, and things like that that are going to draw more attention if it's shows well, priced right.
Yeah,
That's correct.
So here is you had mentioned Brandon about maybe things could get worse before it gets better. Let me pull up this chart here, because this was I was teaching some presentations in Colorado Springs and Fort Collins. And I don't know those markets nearly as well as I know Denver, right? So I presented some high-level Colorado trends. I was really curious just to ask the audience there. I'm like, hey, where do you guys feel like Colorado Springs, Northern Colorado, like where are they in the market cycle? I was like, oh, this would be a fun thing to talk about on our monthly market podcast on here. So what I have on here is the 4 phases of real estate. I think this is a chart many people have seen out there before. It's been around, that's forever, in my opinion, I've seen. But the 4 phases are: phase 1 is recovery. Phase 2 is expansion. Phase 3 is hyper supply. And then phase 4 is recession. And so, hey, going back to, 2009, 2010, we started the recovery, right? That's when a lot of the single family residential, we were in that recovery after that horrible recession, after that crash, or maybe, we're going from recession to recovery on there right now. So my question here is, obviously different asset classes, as Troy was talking about, there are different parts of the cycle. I'm curious on everyone's opinion on here where residential, or should actually detached single-family homes sit on here, because this is the one I'm having the most trouble with plotting. Condos, we're seeing price drops on there. Multifamilies, we're seeing some price softness. Apartments, we're seeing big price drops on there. Mm-hmm. Apartments are in the recession. But when you look at like single-family, this is all defined by supply and demand. And so we're still in the seller's market technically, and we still don't have demand and supply equal on there. So are we in the expansion phase? We're in the hyper supply phase? Like, where do you guys think, like, what number on here do you think we are on the single family? Because like I talk myself onto one side one day, because it's not like 2008 where we had all this inventory flooding. We had all people with bad loans, and most people are upside down in their properties. We don't have that. We have a very strong borrower profile on people who own properties, huge amounts of equity in there as well, but we're not having this surge of inventory, yet prices are pretty flat. So are we in this hyper supply where supply is building from people naturally listing? Is this a phase we're in? Now, you guys got any thoughts on here?
Let's hear it, Jeff.
Man, no one wants to take this.
No,
it's a hot potato.
It's
a hot potato.
I think that the model doesn't necessarily apply perfectly to detached single family.
Okay.
I think it's driven on the market. This thing feels to me like it's built on market demands as it relates to apartments and how investors behave and that kind of thing. So I think there's probably still something similar, but maybe like there's potential that it's just a much flatter thing. And there's just the added, like, interest rates don't enter this equation as part of this cycle, I imagine, right?
No.
Like there's no obvious point here where you have low or high interest rates. So I think that's just probably an overlay of what's suppressing prices and transaction volume right now.
Right.
I think a big part of it too. Well, I guess I would, to answer your question, I think it's kind of more balanced. So I think it's in between phase 2 and phase 3, that demand number 11. Just because they have so much equity. This is not 2009 where you have this oversupply, right? So you have all these people that could sell tomorrow, cash out, But what do they buy next? Now their mortgage goes from $2,000 to $4,000 for the move-up buyer, right? So the move-up buyer is not moving up; they're just getting bunk beds or staying down
or doing home equity loans to improve the property they have to make the best of what they have because they don't want to give.
There's so much equity that's not being like. It's not like these are terrible. Like actually, all these ton of loans. Troy probably knows the numbers. Like how many people have below 5% mortgages right now?
Oh, I haven't seen a stat on that, but there's still a fair amount out there that haven't sold
Refi.
off. I mean, so we still have a
paid
little bit
off,
of
we
have
have
a COVID
So,
hangover.
I read a study about this. I wish I saved the chart, but it said right around about 40% of homes now have no mortgages on them.
Wow.
And this is a national trend. It's been growing the last 4, 5, 6 years.
I've seen some of that. Yeah,
like
definitely
it
cash
was
owners.
like close to 40%, which was
That's pretty staggering.
so higher than I thought it was.
So you have a ton of equity. That's just so people can sell, but they choose not. Like the ones that paid off, amazing, right? Good for them. But the ones that have loans on it, I think a higher percent because of the COVID artificially, like almost crazy low rates we'll never see again. They're almost in this weird, like until rates hit below a certain threshold. And Troy probably knows whatever. I'm sure you have economists at Nova like, hey, if it hits 5.99, I'll bring a ton of refis.
I think the talk has been more fives.
Five-ish.
If we start seeing fives on a regular basis.
Unlock that supply of all
gets
that.
people to start to react.
Yeah, because like single family, especially like who is a single family borrower, right? Usually it's like not investor. It's usually someone living there, primary residence. So they're not going to just move unless they have to. Divorce, death, like you'll have that supply of people that have to sell. But the ones that want to go from the 2-bedroom starter house to a 4-bedroom, they're not going anywhere now. They're just holding off because they have that great mortgage rate.
And the first-time buyer right now is in a great position to its rents are down, a lot of inventory of stuff to pick from. So there's not like a huge motivation to get out of the renting world.
Right.
I'd argue for investors, they should be so happy right now. Because think about investors, what do they want to deal? What's the best time to get a deal when the market's tilted a little more to the buyer side? So investors should be so excited at this moment in time because, especially on single family investment, it's like, who's your competition? It's people that are willing to pay, like a normal family, they'll pay way more than any investor will. Mm-hmm. But if they're not, if they're on the sidelines because they're getting a good deal on rent, like we'll just wait till the rates drop, the investors should be cleaning up for single family deals.
We're not seeing it yet, but
hopefully. But the problem is single family is so high.
Prices,
price to rent
come
ratio.
down more to start penciling out.
Exactly.
So you think we're at 11 here, huh, Jeff?
Yeah.
Demand supply. So the other way to view that would be you're saying we're at the top of the market. That's what the graph is saying.
Yes.
The crash is coming.
Yeah. But I look at markets like a Denver, like we saw, it's pretty flat, right, year over year. So because unless we have another 2009 great financial, like a recession where we go into deep recession and people have to sell at that point, right? They can't afford their mortgage, but they have so much equity, right? So you're not going to see this wave of tens of thousands of foreclosures again. So I don't see a crazy price correction, right? Usually recessions, you see appreciation, like stuff goes up in value. It's only 2009 is the only more recent one that went down. And that was because of unique circumstances. And most people they have 30-year fixed rate debt now, not all these weird adjustable rate mortgages.
Right.
Commercial, on the other hand, Chris.
Different story.
Yeah. That could be,
But I agree with on the residential. I think we're a little farther along here, other than like 11 there. I think we're probably more in like a few numbers past that.
Yeah.
But I agree. I think it'll be a very like soft correction or soft recession because like single family home prices, like other than some, again, some markets have gotten hit way harder.
Yeah.
Others are still seeing strong appreciation. But this talks here when rent growth is positive but decelerating is what they kind of classify as phase 3 hyper supply. And that's definitely what single family homes have been doing. Like rents are still, I mean, on your trends, rents are still going up a little bit on single family, but not like they were, right?
Yeah, rents tell the same story here where it's like, if you look at an average across our whole portfolio, we're seeing a little bit of a drop. If you start isolating single families, doing okay. And there's micro markets there maybe, but by and large, that as a group, those have performed fine. It's really the condos and attached that have that have been hit harder and are taking up most of the losses.
I go back to what Brandon was saying earlier. I think the single family detached is a lot flatter curve.
Yeah.
That's really accentuated there.
I agree. I think it'll be a lot flatter. And it's kind of, because you look at like, from the 2008 crisis, a lot of the multifamily people can say, oh, look, multifamily didn't get pummeled back then, right? Like they kind of look like how single family does now. Hey, they took, a little bit of a black eye, but not crashed. I think it's at the opposite now, where single family residentials, they're having their small correction being flat. And now we're seeing prices just, really crash on the apartment side or on the commercial side.
Yeah.
So I pulled up, because I know you had an article, Brandon, on vacancy in Denver. Do you remember what the vacancy was in the headline? It was like...
So we looked at both residential and then downtown condo, because we've hit that a few times on here. And it's just, it's as high as it's ever been. They've only tracked it since like 2006, but there was some speculation in the article that downtown vacancy office rates were around 30% back in 1990 when we had the oil and gas crisis. We're at 35. We're over 35% today. So it's as bad as it's been in at least a very long time for the downtown office thing. And I don't know if you guys go down there, you can feel it a little bit, and just certainly not the energy that we've seen in the past.
Do you guys go downtown often anymore?
Not a ton.
Yeah,
Been a while. Maybe an event.
I'm boycotting the Rockies, so not as much as I used to.
Why are you boycotting the Rockies?
Because he
they're
doesn't.
terrible.
He wants to cheer for winning
There's
team.
no plan.
So go there and drink more.
Yeah, it's still an entertaining venue.
Yeah.
The game's
That's
happening in the
the problem.
background.
Well, the 16th Street Mall redevelopment's not helping either,
I
because
know.
that's
what a disaster.
that's blocking. I feel
Yeah.
bad for those small businesses right there.
I feel horrible for
because they can't do anything about
No.
it, and they're just going out it like it's just there's nothing they can do. They have to wait years, however long that's going to take, if they survive, and then eventually maybe they'll have. It's almost like they have to revitalize, because that's what 16th Street Mall did back in the 80s. It like revitalized downtown.
Yeah.
Big time.
So they
So maybe we'll
it's like
have
a second
another rebound.
Yeah, second rebound.
I know it's a priority, right?
Yeah.
So like even like in the last mayoral race, that
Yeah.
was a talking point at some of the
Yeah.
debates and stuff like that, of just like the long-term plan down there. So I don't think it's going away and to never come back, right? Like I think
Oh, yeah.
It goes cycles.
I think
It's a
the
cycle.
overall people recognize like the benefit that a vibrant downtown can be to the city, but it could be a while, and I don't know how far out they are on that.
Yeah.
Fixing everything. It seems like it's been under construction forever.
So here is CoStar Q1 report for Denver. So it's Denver multifamily. According to their data, you guys should probably see this right here. They have Denver multifamily vacancy peaking last quarter, so like Q1, Q4 2024, right around 11.5%, 12%, with vacancy starting to soften here, or go down, I should say, in terms of it. And a lot of it has to do with construction. Oops, that's the wrong chart there. Here's a construction one. So those orange bars are units delivered, and you can see that dashed vertical line is where we are now, end of Q1 2025. And you can see, the last 2 years we've seen a lot of supply come along, especially 2024.
2024 delivered 5% of all the apartments that exist in Denver.
Was it that high?
Yeah.
Yeah.
No kidding. That's an interesting one.
Now you can see 2025 is, more than half of what 2024 will be like. And then once you get into like 2026, there's a quarter of nothing, and then things start leveling off on here. Yeah. So, hey, no surprise, right? Lots of supply coming online. Yeah. That's going to push vacancy up, which will push rents down. And then they were saying year over year, rents are down negative 2.9%.
Yep.
And this is Class A, Chris, right?
This is all Denver multifamily.
Okay. Is this 5+ units, right?
Yeah, 5+.
They're not looking at anything under 5 units.
Yeah.
Okay.
And so this is it. But the Class A, all the new stuff is Class A, and that's what's pushing down the rents,
Yeah,
right? And
right.
this is why
Right. Big
Class
supply.
C properties are just getting creamed right now with 20% rate drops, and price drops going up there as well.
Yeah.
So I think for this, coming back to,
So maybe we're in
forget
that
this
cycle of the
chart.
market where it's like I feel like some deals are starting to trade, but there's a lot of investors who want out, but it's just so painful when they knew the valuation was like, 25% higher a couple of years ago, and so they're not like, they're feeling the pain, but not enough to like hit where the market's really at today.
Yeah.
There's a lot of stagnation there.
Well, I think it's going back to what we've seen with a lot of the residential, especially like even the small residential multifamily as well, right? Like I've told you guys, I want to sell this fourplex. I don't think I'm gonna sell it, or I'll sell it anywhere the price I want it to sell for what Brand's alluding to, right? I mean, I just did a $100,000 price drop, and a couple of weeks ago, it's still zero interest on there.
Yeah.
So your return on equity is looking way better than it was because the equity is way smaller.
Yeah, exactly.
What you were modeling.
it might, if I'm using those real numbers, it might go up some. And so, most likely right now, I was thinking over the weekend, I'll probably just pull it off the market and hold on to it because I'm in a good position. I got 3.5% debt on there.
Yep.
While I would like to sell, I also don't want to Greg, I can sell now, but take a $200,000 haircut.
Yeah.
Like the new investment I'm making is not going to make up for a $200,000 difference.
Right.
Now, this will probably be another 2-year hold for me, I would imagine, to kind of get a price. But as of right now, like that's the situation I'm in. That's where a lot of these residential detached single family people are in as well. They're like, hey, high equity, good position, low debt. A lot of people can hold on to it, but you get like the commercial multifamily stuff, they
Start
can't.
getting some balloon payments,
Yeah,
and
well, I mean,
stuff like that, and they're hurting.
Their debt went from
Oh,
3.5 to 7, 8, 9%. With
Oh,
taxes going up, with insurance
And
insurance
when
going
they
up.
underwrote this, they modeled out that rents would be up
9% annual rent growth forever.
Yeah, totally.
Right.
It
Oh,
was 3%.
God.
Yeah, maybe not quite 9%, but
Yeah.
I might be a little facetious there.
Yeah.
But yeah, you're right, and that's the pain. That's where things are starting to trade. So a couple guys I know who are very active in that space, they're saying a lot of banks are talking to brokers now. They're like, hey, we need to move this off our books. Now, of course, those take a while to play out, but they're like, yeah, the last couple of years, haven't talked to banks now. Every broker in Q1 is essentially talking to banks who want to start moving some properties.
Yeah.
So I think we're in phase 4 recession here.
Have banks been taking those properties back quite a bit?
I don't
Or
think
are they
I think they're
working with
starting
people?
to, but they've been
Okay.
doing like the extend and pretend, right? Hey,
Yeah.
because the banks don't want the properties back.
Yeah.
Because once they do, they have to realize it, then mark their books
Yeah.
up, and
Yeah.
but I think now they're forced. They're being
It's
forced
like
to
that's
for
the,
a variety
that's the
of
best
reasons.
option. On
Yeah.
some of them.
Yeah. Or cash in refinance. That's always a fun conversation with those guys.
Cash in.
Yeah, let's just throw up
Bring
an
in
extra
$4
5.
million.
Yeah, extra, or go to their investors like, hey guys, actually we were wrong with all our assumptions, so we'll just give us another $2 million, please.
Yeah.
Yeah.
So yeah. So I know we got a few minutes left here. Any other data points, articles? I know you had some other articles or
Yeah,
topics you
just
guys
the
wanna talk
one I
about?
wanted to highlight for anybody who's lived in Denver for a number of years. You've seen it's been on the ballot multiple times where the Park Hill Golf Course closed down. A developer bought it, assuming they could get rezoning done. They've been shut down multiple times. They put it on the ballot multiple times. Spent a fortune on advertising. Again, if
Yeah.
you lived in Denver, like it was every day you were hearing like of all the reasons you should vote to approve the new zoning, but it kept failing. So it was just this gridlock, and if you drive by there, it's just like a fenced off bunch of dead grass. It's kind of an eyesore. So I was excited to see there's finally something in play here where City of Denver is going to swap another piece of land with this one. So give the developer something that's out by the airport where they can develop. And I guess they have some other property out there. This developer does. So they like that. It appraised for like 12 million or something, this other property, and they paid 19 million for this one. So
So not
it's not a perfect deal, but yeah, they're also just sitting on this thing, and who knows what holding costs they have and all that.
So what are they going to do to the golf course then?
So then the golf course will become a park
Okay.
that the city will develop. So it didn't get into exact plans, and the city still has to go through a zoning process and that kind of thing. But yeah, hopefully something's coming there that'll look nice, be usable.
Yeah, I mean that would be
Better use than an empty.
an
golf
empty,
course,
ugly, vacant lot.
Yeah.
It's not good use. Troy, what's going on with rates, man?
Still kind of flat, from what we've been seeing. So mid high 6s on a 30-year fix, generally speaking. Different situations demand different numbers on that, but that's from a very general sense. So tariffs we talked about last time, the big T word, seem to be subsiding, which is kind of nice. Stock market coming back, but yeah, it was not looking pretty there for a little while.
Is there any data points you have to look forward to with the Fed or economic
Gosh, it's such a
Jobs
Wild
data,
West
or is it all over the
thing.
place?
I mean, I think the jobs are the big thing for the Fed. Seeing where that's going, they're definitely taking cuts off the table until they kind of see how this stuff settles down, which is unique territory, really, right? I mean, there's never been such an aggressive tariff push that we've ever seen. So I think they were kind of navigating those waters a little bit. And the Fed always tends to be a little bit behind the curve. They don't adjust soon enough when the data is kind of showing it, and that's usually why we get some of these overreactions in the markets. But I'm still hopeful we'll see some better rates, but I'm not counting on it.
I think they were forecasting those. So they read last week. They aggregated all the top banks and economists,
forecasters. Yeah,
and I think they were saying their best guess was, or the consensus was, Q1 next year they'd be in like the low sixes. I think it was like 6.2, 6.3 was what they were,
Yeah. They could make for a good 2026 if we get into the low sixes, upper fives. I think, like you were talking about earlier, Jeff, some of those people that are tied in with equity and great rates, they might be more inclined to make a move.
Yeah, go from a 3 to 6 is better than a 3 to 7. So they'll be more likely to refi or purchase another place.
The last thing I'll say is, Rev, I'm really curious. I know either when we look at May or June, because I think it was May or June of last year is when we saw the inventory really jump up. Like that's where we started seeing like 50% year-over-year increases all the time. And I think is next month when we will kind of be that 1 year mark. I'm curious to see how much inventory jumps up from the 1 year mark from a year ago. We saw that inventory.
That will be interesting to see.
Because there's we got that going on, and then I haven't seen any data. If you guys have it out there on, I'd love to see. Like I don't know the data for like single family new build or new construction Denver Metro. I know like nationally there's a lot of inventory coming on, especially like the South and Southeast. I mean they have I don't know if it's a flood, but lots of inventory coming on from home builders. I'm curious what the home built inventory is looking like in the Denver Metro right now.
Yeah,
it'd be interesting to see. I really don't know.
It seems
myself.
somewhat limited. I don't know the actual numbers, but they're not building here like they are other places.
Yeah, it's not massive like in Tennessee or Florida.
And we haven't I don't think we have any build to rent detached communities and stuff like you see.
Nothing going on there.
You can't make the numbers work, unfortunately.
Yeah.
Cool. All right, guys. Well, this is another fun podcast.
Yeah.
Appreciate discussion. Fun seeing where the market will be. But I'm really curious to see inventory levels next month and see how that starts impacting prices and all that. So, Jeff, Troy, Brandon, as always, thank you guys so much.
Thanks for having us.
Thank you.
Bye, everyone. We'll see you next month.
Bye.
Bye.